All right, everybody. Thanks for being patient while we got the panel set up. Welcome, everybody, to our first FOMC and macroeconomics space of 2024. There are a lot of things to touch on today, so I'm really excited to get our panelists' takes on recent data and how things are kind of looking moving forward. Now, as those who frequent our spaces know, I like to keep these panels super open for discussion. So if you have anything to add as we go along, please feel free to just use that Twitter Spaces raise your hand emoji, and I'll know to call on you. That way we don't have any kind of background noise when other people are talking. So if you can just keep mics muted while others are talking, that would be perfect. So I'm just going to kind of run down our panelists here, and we'll also be joined by Michael Cow later on in the space. But for now, we'll start off with those who are here. We've got Joseph Wang, our go-to Fed guy. As many of you know, he headed the trading at the Fed's open markets desk, has an amazing introductory book on central banking called Central Banking 101, which I highly recommend people read. And he's the CIO at Monetary Macro. How's it going, Joseph? Thanks for coming back as always.
Hey, Nicholas. Hey, Unusual Wells. And hey, everyone else. Thanks so much for having me. Glad to be here, and this is my favorite FOMC space.
It's my favorite FOMC space too, Joseph. I might be a little biased, though. Up next, we've got Jem Karsan, the leading volatility expert and the founder of Kai Volatility. They're launching tons of new and innovative things coming up in the next months, so check them out for sure. Welcome back, Jem.
Hey, guys. Great to be here. Look forward to it every 6 weeks. Always a great conversation. I always learn more than I give on this one. This is well worth everybody's time.
Oh, I certainly learn more than I give. I come in here like a baby deer on new legs, and I leave feeling a lot more confident than I started. Next, we've got the Last Bear standing, a friend of the spaces. Last Bear is an expert on markets where he writes about monetary policy in his weekly Substack. If you're not subscribed to that Substack, you should be. I learn a lot from that with every issue. Welcome back, Last Bear.
Thanks, guys. Thanks for having me. Like everyone else said, this is a great room and a good group of panelists that we have here, so I'm looking forward to it today.
As am I. Thanks for coming, Last Bear. Next, we've got Bob Elliott. He's a CIO at Unlimited Fund, former IC at Bridgewater, and the all-time leader in useful Twitter threads during a banking crisis. He's also a friend of these spaces. We love having him on here, so let's give him a warm welcome back. How's it going, Bob?
Hey, thanks so much for having me on. I almost are we having another banking crisis today? I don't think so. No need to get out those threads again.
I hope not.
Just thank you so much for having me. Great to get on with everybody, and it's always such a great panel that I get a lot out of. And this time coming live to you from the iConnections conference. So if you hear a little background noise, it's a little conference vibe going on behind me. So happy to be here.
Happy to have you, man, background or not. So like I said, Michael Cow will be joining us about 20 minutes into the panel, but I do want to kind of get things rolling here. So before we get really started, let's get a quick macro overview of the last month since our last FOMC panel. Now, since we last spoke, real GDP increased at an annual rate of 3.3% in the fourth quarter of 2023. Unemployment was relatively unchanged. And by relatively, I mean entirely, at 3.7% in December, with payroll employment increasing by 216,000, beating the estimated 160,000 by a pretty wide margin. Following the jobs report, Yellen was cited as saying that the U.S. has achieved their soft landing goals thus far, and given the GDP print and core PCE from the fourth quarter of last year sitting right at 2%, others are echoing that sentiment. So honestly, let's go ahead and start right there. Let's go, Joseph, if you could start us off here. In your recent Markets Weekly video, you commented on the soft landing, indicating that you believe we're on the right path to that end. So to kind of get things rolling here, do we have enough evidence now to affirm the path to a soft landing? And what things are we missing in the macro overview at the moment, Joseph?
So I think we have enough evidence, not just to say we're on the path, but I think we're reached the destination. Now, in thinking about this, I think we should just rewind a little bit to think about what's been happening the past 2 years. As we recall, inflation was very high, and Chair Powell gave a speech at Jackson Hole saying that basically there will be some pain. The thinking is that he would cause a recession by raising interest rates, unemployment will go up, and that would cause inflation to go back towards 2%. A soft landing would be being able to return to the Fed's inflation target without causing a recession, without causing a rise in unemployment. Now, when we look at the GDP data, like you mentioned, we see that over the past 6 months, core PCE, bang on 2% Fed's target. GDP continues to grow above trend. Unemployment continues to remain low. Wages continue to grow. So, that's basically reaching soft landing. Now, going forward, maybe inflation reaccelerates, maybe we fall into recession, but we've very much achieved soft landing. I mean, just look at where inflation is, and just look at where GDP growth and unemployment is. I think that's a case closed, but we should look forward from there.
Yeah, and we'll definitely touch on both of those at length. Thank you, Joseph. Last Bear, I'd love your take here as well. How are you feeling given the recent data releases regarding our trajectory toward that soft landing?
Yeah, I think that what we've seen throughout the past year of 2023 was growth that sort of far outpaced what a lot of expectations were. And I think that a lot of that comes back to financial conditions sort of reaching their tightest point all the way back almost over a year ago in late 2022. And despite the fact that the Fed has continued to raise interest rates throughout the first half of 2023, the reality is that financial conditions have continued to loosen as market participants have a better idea of where the terminal rate is going to be and sort of are looking forward to rate cuts in the future. And so I think that a lot of the economic data continues to just support that position. The one area that I'm a little bit less optimistic around is the labor market, which, despite the fact that it's held up much better than many people have expected, including myself probably a year and a half ago, it continues to show deceleration in terms of wages, in terms of some of the softer indications of sort of trajectory, whether you look at JOLTS data, whether you look at temporary workers, or sort of those more macro sort of cycle type indicators that sort of point to weakening in the labor market, which I think you can see in a ton of different surveys and a ton of different sort of soft data. And so we haven't seen that crop up in terms of initial claims and continued claims and official unemployment rate on the aggregate level, but it is an area that's I think the Fed is sort of looking at closely and will be a factor as they continue to make their monetary policy for the year ahead.
Thank you, Last Bear. Jem and Bob, kind of the same question here. And are we missing anything with regards to the economy's growth from the onset? Is the destination already here? Let's go, Jem, then Bob.
Yeah, I think one of the big things I like to highlight is, we can talk about the economy and we can talk about markets, and those two aren't exactly the same thing. They're actually often very, very different. Again, I've talked about the 60s and 70s before, a lot of the same structural issues happening at that time, obviously different things as well. But if you think about that market, 68 to 82, this is something that really blows a lot of people's minds when they go under the hood, is growth was above trend. GDP growth was actually higher in real terms with a lot of inflation, nominally way higher, but in real terms, it was above trend, higher than it has been the last 30 years. Yet that market lost 70% of its value in real terms. And I think that is something that people have completely lost sight of, right? People are looking at the market and saying, what are markets going to do? Is the economy strong? Are we in recession? Are we not? I think that misses a huge, huge part of the picture when we're thinking about markets and how to bet on these outcomes. Why did that happen? Why did we get massive contraction? Because interest rates kept trending higher for liquidity reasons, for a lot of other reasons, because there was structural inflation. So we can cyclically battle structural inflation in the short term. We can slow inflation, but what does that really affect in terms of long-term yields? And that's what really matters here. What's happening more long-term, not in this kind of cyclical world, and what's happening to margins and what's happening to flows. And in that world, this tech rally, the Mag 7 kind of rally, is really reverse trend to what I believe is a bigger structural inflationary pressure. So we can talk about the cyclical effects, increasing unemployment, potential coming recession. All those things happened 3 times throughout the 1960s and 70s, but duration really got crushed during that time. A lot of other structural rebalances. The rotation that we get is important. So I think the one thing that's really out of line here, and we're starting to see today, I can get into structural vol effects and why we've been seeing what we've been seeing in terms of short-term liquidity and tech flows. But I think this is an interesting, the earnings yesterday mark a very important point in the rotation of tech versus the rest of the market. I think that's something we'll dive into later today.
Thank you, Jim. Bob, any comments before I pick on you with our first question?
I feel like I should come out with a Lee Corso style, not so fast on achieving the soft landing. Hopefully some.
Oh, let's hear it.
Hopefully some portion of the listeners know what that reference is. But I think we certainly have reached a point which would be consistent with a soft landing, which is decent GDP growth, no deterioration on employment, and inflation back to the Fed's target. The question is not, do we have a print or a couple of prints that meet the soft landing? The question is, do we stay there for 6 months or a year? And when you're trading markets, that's really what you care about. You don't really care about, did we put in a few prints that look that way? And that's where I'm a little more skeptical. Now, I think my skepticism is placed in a slightly different place than it is than that of Last Bear, who is a smart guy. You should definitely follow and read his stuff for sure. I think I'm more concerned about the inflationary acceleration occurring, and particularly around the composition. If we get down to the composition of how we've achieved inflation close to the Fed's mandate, what we've done is we've had really weak, particularly goods prices, and falling, the direct and indirect effects of falling oil prices and gas prices really help get us to the point where we're getting that 2% print, and we still have elevated services prices that probably won't get as resolved as quickly, either housing or non-housing, as people expect, given wage inflation, and also given the aggregate tenant renewal rate that's going on, rather than the new tenant renewal rates. And so I put that together and I say, looks like we could have more services inflation for longer than people expect, and the odds that we'll continue to see meaningfully negative goods price inflation like we've seen would require continuation of price falls at the same pace that they have been at. I'm not sure we can necessarily predict that in the future. We've seen gas prices stabilizing here, or a small uptick. There's reasons to believe that the geopolitical issues will flow through to rising goods prices on a long lag, but by the end of the year. And so I look at that combination of things combined with an economy that's doing pretty well. And I think we could easily start to see, a bit of a takeoff again in inflation, not in 2 months or 3 months, but by the end of the year. And that would be inconsistent with having actually achieved the soft landing in a durable way rather than in a short-term way.
Thank you, Bob. Last Bear, do you have any comments there since he spoke to some of your points?
No, I think I think the future is we'll have to see what happens with inflation moving forward. I think that is a risk that you could see. If everything continues to be on the upside from economic data and employment data and everything holds together, then there certainly is a case that we sort of hit the low point for the reasons that Bob mentioned, oil and goods and all those things start to normalize and sort of reach a point that's higher than what the Fed's target is. And I think that to the extent that happens, it would throw a major wrench into sort of the path of monetary policy, which both based on the dot plots going forward and market expectations going forward, is that we're going to see significant rate cuts over the coming years. So that would be unexpected from a market perspective and would probably be painful for a lot of positions.
Thank you, Last Bear and Bob. So I do kind of want to spin the topic here. Well, first, actually, does anybody on the panel have anything to comment on what Bob and Last Bear spoke about before I get to the next question? Okay, so I want to pivot here a little bit toward the rate cut discussion. The projected chances for a rate cut in March currently sit near the 50-50 mark at 46%. But I mean, like a mere week ago, if I'm not mistaken, it was as high as 65 to 70%. Now, Bob, you said on Macro Sunday with Andreas Steno that you saw zero evidence for rationale of such a cut in March. Could you walk us through your take there, Bob? And then after that, I'd really like to kick this around the panel after Bob's comments.
Well, I think anytime you're trying to predict one particular meeting versus another, it's a bit. My point was less about like literally March and more the general dynamic about saying, look, is there an urgency to cut interest rates at this point? And I think, and from what I see in the macroeconomic data, I don't necessarily see that. And I have people, often people get really focused on the context and the trend and the commentary and stuff like that. But if you take a step back and you look at what's going on with the U.S. economy in aggregate, we basically have an economy that is, has been growing at or above potential for 6 quarters, unemployment at secular lows, inflation that has moved back to roughly the higher end, let's say, of the mandate, and following a period of inflation that it was relatively elevated. And you sort of look at that combination of things, I should say, and also an environment where asset prices have gone up, 10 to 20%, depending on exactly how you want to take a look at it over the last 3 months, and are at highs. If I were to just tell you that macroeconomic set of conditions and place you in any, developed world economy, what would be your expectation for the future path of monetary policy? It wouldn't be 150 basis points of cuts happening in relatively rapid succession, right? The macroeconomic conditions don't align with that set of dynamics, and I think it really centers around. So that's the core point. When you look at that, it's not obvious to me, like in many ways, if you look at it from the Fed's perspective, they're accomplishing their mandate at the current level of interest rates. Why do anything in order to upset that circumstance, either to challenge inflation, particularly to challenge inflation on the upside, or overheat the economy by cutting? And so you look at that set of circumstances, and I don't see necessarily the fundamental rationale for delivering anything close to what's going on. And the last thing I'd say is, I'm sure we're going to talk about real rates, and people are going to make the case that, mechanically, if inflation falls and interest rates stay the same, that there's a tightening of real interest rates. And that is just not, like, that is in a theoretical sense true, but not in a practical sense true. The fact that wage growth has remained elevated and inflation rates have come down has given the consumer more spending power, not less spending power. It is a easing, not a tightening, and it's an important reason why we have strength out of consumer demand. And so to use that as a reason to cut interest rates when we're seeing the exact opposite response from the U.S. consumer is highly indicative of the fact that it's a theoretical point, not a real point based in the fundamentals of the data. And so that's, so even that case of the real interest rate tightening point, I just don't find it compelling.
So I'll take the real interest rate framework thing. Well, first of all, I want to agree with Bob. I think real interest rates is just a theoretical framework. It's probably not useful in real life. And I also believe that later on in the year, there's a good chance that we could see inflation reaccelerate. But the game is guessing the Fed. And so you have to put yourself in the Fed's shoes and look at the world the way they see the world. And if you look at if you listen to what they've been saying, then these 5 or 6 cuts priced into the market for the next year is actually really reasonable. Now, since late last year, you've had Chair Powell at the September meeting talk about cutting rates to maintain real rates. You'd have John Williams, president of the New York Fed, sit down with the New York Times reporter and basically give a 101 on how he thinks about the world through the lens of real interest rates. You've had Governor Waller say something to the same effect, I think in November last year as well. So the Fed likes to look at the world through the lens of real interest rates, rightly or wrongly. And real interest rates are nominal rates minus expected inflation. If you look at expected inflation based on consumer survey data, like say the New York Fed's consumer survey, University of Michigan survey, and then you look at nominal rates using, let's say, the 1-year Treasury bill, then what you see is that real rates have basically remained around slightly below 2% even after the market prices in all these cuts because consumer inflation expectations have come down so rapidly. Now, we also more recently, just this month, have heard Governor Waller reaffirm that he thinks financial conditions are restrictive and so forth. And these guys are probably thinking that, real interest rates, even accounting for all these rate cuts in the market, a little bit below 2%, and let's say neutral, about 0.5%, so it's restrictive. And I agree that this is probably nonsensical and not useful in understanding the real world, but I think it's useful in understanding the Fed. And so I do think that the market's pricing all these rate cuts makes sense according to how I see this.
Thank you, Joseph. I'm going to kick this around the panel, but let's start with Jem here. What are your thoughts with regards to cuts, Jem? How is volatility pricing things with regards to overconfidence in rate cuts? And generally, can you walk us through how volatility changes as the futures change for rate hikes, Jem?
Yeah, so I think a critical component here of what we're seeing is that markets are, and this is what markets do, are forcing the Fed's hands. Like this is a kind of reflexive game. And December 12th, the last time we heard from the Fed, the market was almost 10% lower. Never mind when they made the decision, right? And so we have markets that are, creating a wealth effect and driving growth. We have lower yields that have been a function in the last 6 weeks of what the Fed has said, and that's stimulative, as Bob mentioned. And on top of that, we have other inflationary forces. We've had 2 numbers come out, both CPI, and we've had a couple of unemployment readings that have been broadly still again a hot to warm economy. So we can keep looking forward and saying transitory and doing all these things, but we're at 3.7% unemployment, and to Bob's point, that is not in line with kind of, you can use whatever framework you want, but that is not in line with a economy that is really cooling in a dramatic way. So I agree with Bob's point as well, that ultimately that we're we can print. We did this many times in the 70s, not to keep drawing upon that data set, but it's the last inflationary data set we had, where things appeared to be lower inflation, that we had slowed inflation, and that growth was not too bad yet. But this is about trajectory, and we have to. Where are they going is really the question. We need to be skating to where the puck is going. So I agree with a lot of what's been said here today. I do think unless the Fed slows today the kind of dot plot picture that they really painted 6 weeks ago, or pushes back against what the markets see coming, I think we're going to have a continued acceleration, and we're already seeing market up, vol up, to get into the vol picture, because expectations of this fast were underestimated, and call skew, take out today a little bit, was has been at record levels, particularly in some of these tech names. That flattening of call skew, that squeeze, if you will, will continue to put pressure on the upside until because people broadly weren't prepared for that 25% rally we've seen. It's too far, too fast, and again, it caught markets off guard. Whenever the Fed catches markets off guard, either direction, that's dangerous. That creates underlying volatility and under positioning that can create a wobble, I guess I would say. So be careful. The faster we go, the more we squeeze to the upside, the more potential energy we create, the less vol supply we have because it's being taken, as we've seen the last several weeks. Dealers are being taken out of their vol as we go to the upside, and vol is just too cheap. It's too easy to own vol and make money. So I would say structurally, what the Fed is doing here, if it continues to push an agenda of really stimulating in the face of without the proof that this economy is slowing to the extent they say it is, this market could really rip and reflexively create a real volatile situation going forward. And again, that doesn't mean in 1 month or 3 months, but they're really managing this. And one of their mandates, whether they verbally say it or not, is to dampen volatility and to smooth the business cycle. So I'll be curious to see if they continue the narrative that they had, which caught the market a bit by surprise last time. Because if they do, I think they're really opening downside risk for the market the further this market goes.
Thank you, Jem. Now to kick it around the panel a bit, does anybody have any comments to the last few points by Jem, Joseph, and Bob? And if you have anything to add to what you previously said, please feel free. So what I'll do here is, Joseph, I'd love your thoughts here since we very briefly touched on a comment or two on the Treasury. The Treasury announced on Monday that it plans to borrow $760 billion this quarter, down from its estimate in October of $816 billion. That's a pretty significant difference. And some say that comes due to higher cash balances at the end of Q1 and estimates for higher tax receipts. Due to that, the market rallied over 1%, hitting all-time highs again. And I'd love your thoughts, Joseph, just on that balance sheet announcement by the Treasury, what it means for the markets and why the markets rallied significantly off of that news.
Sure, but I think I saw Bob's hand up. Maybe I'll let him add before continuing.
Sure, yeah, go ahead, Bob.
Oh, yeah, sorry, I was not quick enough on the draw to press all the things. I just want to say, I think Joseph's point about you have to get in the head of the Fed versus necessarily the sort of versus solely looking at the fundamental macroeconomic conditions in terms of understanding what they're going to do. I agree with that point. I think the way in which it's the sort of thing where we can easily see a set of circumstances where they, if they, first of all, I think there's a fair amount of uncertainty about exactly how they're going to respond. I think I have more uncertainty than someone like Joseph has, and he's closer to it, so I think he probably has more confidence in his read of how they're going to respond. But assuming they do respond in the way that Joseph's describing, I think what that does from a market participant standpoint is you've got to think about what essentially that policy error means for the pricing of other things across asset markets, and in particular, just because they make a policy mistake in the shorter term doesn't necessarily mean that their policy over time will be divorced from the macroeconomic fundamentals. And so my guess is if they do come out dovish on the short end, that's actually a bad thing for bonds, not a good thing for bonds, which is a little confusing because typically if they end up cutting interest rates, that's generally a good thing for bonds, but only good in the sense that macroeconomic policy, that monetary policy is responding to weakening economic conditions or lowering and meaningfully lower inflation, and not good if what they're doing is actually easing too much in response to the strength of underlying conditions. So that's my guess. If it's going to be a weird market action, but if Powell comes into the presser very, very dovish, that is a bad environment for bonds, not a good one.
Thank you, Bob. And right before we get to Joseph here, I just want to comment. It looks like we're having some issues with the hosts being able to see what's going on with the speakers. So instead of raising your hand for the emoji, feel free to just chime in. Just give it a quick beat after someone finishes talking before you unmute. Just since we can't see the hand raise emojis, feel free to speak freely. All right, Joseph, hit us with that nitty gritty.
Okay, so also today we had a quarterly refunding announcement, and this has become more of a focus for market participants because it's been more market moving the past 2 quarters. So as we recall, in August, Treasury had their quarterly refunding announcement. They seemed to suggest that, we're going to issue increased coupon sizes for the next few quarters, and we're going to increase them by a lot. And that seemed to catch the market off guard a lot and contributed to a significant sell-off in Treasuries. So we saw yields rise a lot and so forth. But then on the November quarterly refunding announcement, it seems like the announcement was lower than expected in terms of coupon sizes and more of a willingness to increase the share of bills in their debt mix. And so that seemed to have contributed to a rally in Treasuries. And this is kind of unusual if you look back for the past 10, 20 years. Quarterly refunding announcements are things that no one pays attention to, but now everyone pays attention to them. And I think Undersecretary of Financial Markets actually had a nice piece written about him in the Wall Street Journal this week. So today's quarterly refunding announcement didn't seem to have that big of a market impact. So we did see Treasuries rally a lot, but that could be because of fears of what's happening in the banking sector. From my read, the announcement was kind of in line with expectations. Again, the Treasury is increasing their coupon sizes this time and thinks that this is the last increase for quote unquote several quarters. And their strategy seems to be to continue to increase their share of bill issuance going forward to several quarters. So there was a possibility here for them, from my perspective, for them to actually have a big impact on monetary policy in that they could accelerate their shift towards bills. Because when they do that, what they're also doing is two things. They're also significantly reducing the reverse repo facility, which we've seen over the past 6 months decline from about over 2 trillion to, let's say, about 600 billion today. That's largely due to Treasury's strategy of significantly shifting issuance towards bills. This matters because there are some people at the Fed who want to link quantitative tightening to the level of the RRP. I don't think that's a majority position, but there are some people who think that way. And in that case, then, if you're Treasury, you could issue a whole bunch of bills, push the RRP really low, really quickly, and you can kind of lobby for our faster QT, which, of course, the market likes. I mean, faster end of QT, which, of course, the market likes. The second thing, of course, is if you issue a lot of bills, you put upward pressure on money market rates, which everyone at the Fed looks to gauge their sense of quote unquote reserve scarcity. And when the reserves become scarce, when money market rates rise as a spread to IOR or RRP, usually people start calling for an end to QT, which of course would also be market positive. It doesn't seem like Treasury went out of their way to increase bill share, but it is going higher over the next few quarters and far above their 20% target that they used to have.
I want to ask a quick question, actually, if you don't mind, Joseph. What were your thoughts on the extension, a bit of duration in this QRA announcement? And then, do you think there's enough liquidity based on your experience for the increase in bond issuance? Put us all in that seat. And what would it take for the Fed, do you think, to really end QT? I mean, it surprised me to some extent that they're debating that as quickly as they are. Obviously, they will need to bring liquidity in if they are extending duration more. But anyway, I would love to hear your thoughts a little bit about kind of going forward. If you think not just what the market thought, but what you think, liquidity, the current liquidity circumstances are in the bond market, given that.
Yeah, I think that's a great question. So as we know, over the past few months, the bond market seems to have some indigestion, particularly when it comes to longer dated issuance, like the 30-year. So Treasury has been very, very sensitive to that. So in today's QRA, you can see that them shifting issuance towards the belly, let's say 2 to 5, and they're really keeping their sizes in the 30-year. So they are sensitive to that, and they're trying to not trying to load issuance towards segments of the market, points on the curve that are more easily digested, and of course increasing the share of bill issuance. But at the end of the day, the size of the 10-year, 20-year, 30 years is still, looking past a few years, pretty large. And I don't really know how the market would take it. So when I'm thinking about things like liquidity, a big part of that, of course, is just sentiment, perceptions of the future, and so forth. When you look at the asset management community, how they're positioned for duration, they do this via futures, which we can see through weekly data. They're quite gung ho on this. So at least the asset management community seems to be happy to buy this. And of course, the link between the futures and the cash market is through the cash futures basis trade, which continues to grow. And so far, even though the regulators want to crack down on it, so far seems to be able to link the two. And so that seems to be a healthy appetite. Again, the question is going forward, do we see inflation continue to reaccelerate? I like Bob's point that maybe it's not good for the market if the Fed cuts rates. On the one hand, though, you have dovish Fed cutting rates. That's putting downward pressure on the path of policy. On the other hand, if you have a fundamental view, you could think that maybe that's inflation in the future, and so that's bad for rates. So I think it's really cloudy, and I don't really know. My core view, of course, is that at the end of the day, you have unlimited amounts of issuance. Rates are going to go higher, and I also think this is inflationary. But looking to what the Treasury is doing, and of course we have a buyback program that's going to be operational in May. I think they have enough. I think there's enough positive sentiment on bonds, and I think there's enough tools to keep things stable for the coming months.
Thank you, Jem and Joseph. Now, last Bear, I've got something I want to toss your way, but first, I'm curious if you had any comments on to everything that Joseph just said.
No, I thought he did a good job of explaining it.
Beautiful. So last year, we kind of spoke at length about the 10-2 yield curve. Between October and December, as nominal rates dropped, the inflationary signaling waned. But some are now saying that the yield curve is once again hinting at that rebound in inflationary pressures. And I think Joseph did touch on that very briefly there as well. Now, last Bear, maybe you can shed some light on what your thoughts are here. What's the yield curve saying to you? And then I'd like to kick this around the panel as well on their thoughts for the bond markets at large.
Well, I think the point that I would make on the yield curve is that since 2012, the Fed has started putting out forward guidance in the form of a dot plot, which gives not just an indication of where the short-term rate will be today, but the Fed's expectation of where it will be over the coming several years. And I think that does have a significant influence on longer-term yields and therefore the yield curve. And so I think that in order to understand sort of this monetary cycle, I think that a flaw in thinking is to just look at where the short-term rate is, wherever the federal funds rate is, and not sort of look forward into what the Fed is sort of projecting going forward. So I think probably the best case that you can make for rate cuts over the coming years, the fact that the Fed has said that they are going to do, rate cuts in substantial quantities over the coming 3 years, and the market is listening to the Fed and is pricing that accordingly. And so, to the extent that the Fed sort of reneges on that or changes that course of action, you have sort of a tightening, even if they were to keep the federal funds rate where it is today, but they decide not to cut. Because the market is anticipating those cuts and because the Fed has said that they're going to do those cuts, that effectively is tightening. So to keep a neutral path going forward, I think they need to sort of follow through on that rate, on the rate cut path that they've laid out. And, last FOMC meeting was obviously perceived to be very dovish. They lowered their estimates in the dot plot pretty much across the board. And I guess I don't really see any data that's come in between December and now that would make them more hawkish than they were sort of a month ago when they were sort of substantially lowering that forward curve. And so I think that the yield curve is a little bit influenced by those forward projections and the dot plot in a way that it hasn't in prior cycles because that sort of forward guidance didn't exist. As to what the yield curve is sort of saying right now, I think I think that the biggest thing is what I mentioned about the sort of forward guidance in the path of monetary policy and the fact that seemingly everyone sort of takes that as a given that rates are going to come down on the long end, and so that's why you've never seen the 10-year go above or really approach the short-term rate in this cycle.
Yeah, I'm going to jump in here actually. I've said this before, but I just want to keep hammering this home. Everybody thinks about everything because for the last 40 years, that's all that's mattered with just kind of cyclical. Is the economy slowing? If GDP is slowing, then inflation, is going to get is going to come down. And we're going to get deflation, right? I think this structural inflationary pressures, which is really not a function of GDP growth, it's a function of where is the money going? Is it going locally? Domestically, is it going into the bottom part of the distribution? Is this going to? In other words, what people call velocity. What's the velocity of the money in the economy, and that's really a function of where is it going in the economy. And those things are structurally much more inflationary. We're getting again a redistribution of some of the wealth. Particularly the segments of the population that spend 100% of the money that goes in their pockets. And in particular, we're getting deglobalization and a lot of the lower cost kind of exporting of labor and services parts are going the other way. So again, I've said this before, but I think it's important to keep that in mind when you're looking at the yield curve. I think we've, if you went back a year ago or a year and a half ago, all of the deflationistas out there were calling for massively higher unemployment and a dramatically slowing economy. We haven't gotten that. We haven't gotten that for 2.5, 3 years, despite people calling for it. And I think the market's starting to wake up to, this idea of a soft landing. Yeah, okay, you can call this a soft landing. You know what else it is? It's stagflation, right? We still have 3% plus inflation and a slowing GDP. That doesn't mean jobs are decreasing. We're just getting, we're losing $250,000, $300,000 a year jobs in Silicon Valley, but we're adding them at the bottom at $50,000 a year, and those or $30,000 a year. Those are not the same type of jobs. They have different type of spending dynamics about who they're going to as well. So important to note that this is more complicated than just GDP go up or GDP go down. And I think that structural element is something that the market, the longer end of the curve, is kind of realizing. And if we're no longer going to be cyclically, if you think about it, we raise rates 5.5%. How much have we really, yes, we've slowed the economy, but at what cost to liquidity, et cetera. And so that cyclical slowdown is really pushing against a structurally very inflationary pressure. And now, to Bob's point, what happens if they are being dovish now, starting to turn into what's still a relatively structurally inflationary environment? And I think that's really bad, for bonds on the long end of the curve. Obviously, in the short end, it's going to lower the curve. And that's why we're seeing the steepening. And I think we'll continue to see that. What we saw in the 70s when that happened is a loss of faith in the Fed's ability to control inflation. And that ultimately accelerates inflation long term. So something to really keep an eye on. I think this steepening is very important. It's very unique. For the last 40 years, people aren't used to this. And people are playing a very clear game that they played, which is cyclical for 40 years. And this is a little bit different. And I think the market's starting to wake up to that a bit.
Thank you, Jem. Michael, I see your hand there. I'd love to hear your comments, and thanks for joining us late here. And then I'm going to pick on you with a direct question because I still haven't recovered from the cravings I got from all that pasta you posted last week.
Thanks for having me. Sorry for joining late, and I
no worries.
I may be rehashing some stuff that's been said, but I wanted to just kind of second some of the points that Jem just made, because I think when you think about this matrix, a 2x2 matrix of the current consensus, basically starting in the 90s, right? We've had this low inflation, low unemployment utopia, and I think because of some of these structural factors that Jem mentioned, And I'll further differentiate these structural factors by intrinsic and extrinsic. I mean, I think I would argue that there are some structural factors that are intrinsic to the United States, but I would also argue that there are some extrinsic factors that have come from this unique demographic dividend that came out of China over the last 20 years and exporting their labor deflation. And I would argue that maybe the productivity miracle that we saw in the 90s was also enhanced by this one-time demographic dividend. And even though you could argue that especially with AI advancements, we still have this productivity, this inherent deflationary aspect of technology. Perhaps it might be a push now against a reversal of some of these one-time extrinsic, demographic tailwinds that are coming out. So I definitely think that we need to be prepared for the most unpopular quadrant of that 2x2 matrix, which is we could be in a period where there is higher structural inflation and higher unemployment. And I think the Fed is in a bit of a box because, I mean, really, so far, they really haven't had any trade-off between their two mandates yet, right? You could argue that now that we're starting to finally see all these job cuts, they're just starting to enter this period. But to take a step back, like I think last week I posted this tweet. I said, look, if you look at real rates since the 80s or whatever, really, we've been in this YOLO period since 2008, where real rates have been oscillated between negative and positive 2%. You know where they are right now? They're at 1.69%. And the market is clamoring for 6 to 8 rate cuts when we haven't seen any reason for it. And when you consider the fact that we might be in store for this unpopular fourth quadrant that I talked about of higher structural inflation and higher unemployment, to me, it would be a very premature decision to cut, especially in March, but even in May, I would say, because it's not clear at all to me that especially the easing of financial conditions from just the rhetorical pivot back in December haven't created this wealth effect. We're seeing equity markets still at all-time highs. And then I haven't even talked about some of the geopolitical disruptions with respect to shipping rates again, right? So I'm not even talking about that because that's sort of like a one-off, hopefully, right? But the last thing the Fed needs to do right now is to goose demand into a structural and geopolitically exacerbated situation. The last thing I'll just mention real quick is that I've written at length in the past about these, what I call the four horsemen of U.S. economic resilience. And, to rattle them off, one is this structural demographic factor. Two is this, I would argue, the biggest factor, which is this fiscal tailwind between the bipartisan infrastructure bill, the CHIPS Act, and the Inflation Reduction Act. That's a combined total of $2.2 trillion of fiscal earmarks for between the next 5 to 10 years. That's an ongoing fiscal tailwind. The third is that both corporate America as well as consumer America are relatively rate insensitive, and I want to touch upon that briefly too. And then the fourth is relative energy independence with respect to most of the rest of the world, especially our biggest geopolitical rival, China. So on this fiscal tail, the reason why I was late for this call is because I was on another conference call with the largest CLO equity manager in the world, and I was just getting kind of like an industry update. And since credit is my background, I just wanted to mention that when you think about risky yields, right? Risky yields are comprised of the risk-free rate and then a credit spread. Well, you would think that at this stage of the credit cycle, where the risk-free rate has gone to 5.25%, 5.5%, that you would see a pickup in defaults, right? Well, you know what the last 12 months senior sort of leveraged loan default rate is? It's like 1.5%. I think this is the same sort of fiscal tailwind that's been driving this benign behavior. And then to put things into perspective, total corporate debt in the US is 3 trillion. Of that, approximately 1.8 trillion is owned by, sorry, that's total senior secured, that's the leveraged loan market. 1.8 trillion is basically owned by CLOs now. But what really surprised me is you hear about private credit. Would you believe that private credit is now at 1.6 trillion? It's estimated to be 1.6 trillion with only 1 trillion having been deployed. There's 600 billion of private credit dry powder sitting on the sidelines waiting to refinance, even at these rates. So that is what is creating a conundrum for the Fed, actually less so for the Fed, but more so for the rest of the world central banks, because there's no reason for the Fed to be aggressive in easing right now. And so, but you can't really say the same thing for other geographies, certainly not for China or Japan, but I would even say that the Eurozone, I think the Eurozone, they might try to talk tough and say that they're more hawkish than the Fed, but economically speaking, I really think, and maybe I'm going to eat my words later today, I really think that Lagarde is going to have to blink before the Fed. So I'll just leave it at that.
Thank you, Michael. A lot there. Does anybody have any comments to anything Michael said there?
I'll say one thing real quick. I do want to just touch on his point. We're not even talking about the shipping issues, right? Or oil's kind of rise. Everybody treats those as non-core, right? Or not in any way correlated to other inflationary pressures. I think what I've tried to highlight, and I want people to think of, very closely, is when we get deglobalization, which is a function of that protectionism that we're seeing, right? We've been getting protectionist rhetoric by 2 presidents now for almost 8 years, and that's driven by this populist kind of drive. And when that happens, we see more global conflict. We talked about this 6 years ago, 5 years ago, 3 years ago. Guess what? We're seeing war after war. We're seeing more conflict. Those are correlated very tightly to the populist pressures that also drive fiscal policy. And we're going to continue to see those things. So you can't just look at them as one-offs, right? Those are part and core of the inflationary pressures that exist. So I just want to make that point.
Thank you, Jem. So I do want to pivot here a little bit back to something Bob was saying on bonds earlier. So Bob, you tweeted earlier this month that, quote, stocks will outperform bonds as long as the economy keeps going. The economy will keep going as long as stocks and home prices don't fall too much. Prices of stocks and homes won't fall too much as long as bond yields don't rise for too long. Can you dive into that a little bit, Bob? Ooh, looks like we lost Bob on the panel. So what I'll do here is I'm actually going to kick back to what we were discussing earlier that I wanted to pick on Michael a little bit on, and then we'll kick this around the panel. So Michael, you also touched on that topic of real rates in a tweet last week, saying it doesn't make sense that a 1.69% real rate screaming for imminent cuts when it's not at all clear that core inflation won't inflect higher with GDP. So, Michael, can you explain what you meant when you said you're calling a big under on expected cuts this year, and why you, as you put it, have severe doubts that core inflation sinks quietly into the sunset just like that?
Well, I'm going to agree with Jem on what the bond market might do in the event of an aggressive cut cycle. I mean, again, I'm going to caveat this by saying that, unless we see like a major credit blow up, which is usually the impetus for an aggressive cutting cycle, then I could see that changing, right? But as of right now, there doesn't seem to be any indication of that, especially when senior secured default rates are 1.5%. Yeah, so to echo Jim's point, I think that if the markets, I don't know what the odds are priced in right now, but as of a couple of weeks ago, the market was pricing in 6 to 8 when the Fed dots only indicated 3. And I would say that the 6 to 8 are just not going to happen. I even have some doubts on the 3, only because if Jem and I are right about some of these structural factors that are, I think of these structural factors as dry tinder, okay? There are certain sparks that can exacerbate the dry tinder, like for instance, an oil spike, shipping rate spike, things like that. You certainly saw that oil spark in early 2021 and a large part of 2022. You saw, and now you're seeing it with shipping rates. But the underlying structural dry tinder is there, and so the obvious spark would be an aggressive and premature rate cutting cycle. And if they do that, I think what the bond market might do, especially the long end, is akin to what happened in 1982. Because when you look at 79, 80, and 81, you had this period where there were rate hikes followed by a bout of bear steepening, and then another hike and another bout of bear steepening. And then finally, by end of 81, beginning of 82, the economy goes into recession, and the Fed had to cut pretty aggressively. But at that point, though, the underlying inflationary sort of dry tinder had been around for too long. I would say the inflation boogeyman had gotten out for too long, and when the Fed aggressively cut, the market lost all faith in the Fed's ability to tamp down inflation, and so you saw the long end just collapse and yields blow out. And I fear that that's exactly what happens again if the Fed commits to like a premature easing campaign that's a lot more aggressive than say like the 3 dots.
Isn't it amazing how quickly we've gone from a Powell positioning himself as Volcker to Burns? I mean, it really is been a phenomenal shift.
One of the things
sorry, go ahead.
I was just going to add on to the point you and Jen made. So I think of macro and markets as downstream from politics and culture. And like Jim has often noted, we are moving towards populism. And so I think that culture is already at the Fed. If you look at the new governor appointments made over the past 3 years, well, I think what stands out is that these guys basically have no experience in monetary policy. What they do have experience in is labor economics and stuff like that. So that is telling me that you have more of a bias towards labor rather than capital, right? That's populism, and I think that that's going to color how the Fed manages risk going forward between, let's say, potentially over tightening and hurting labor, or potentially under tightening and seeing inflation go back up. So, I mean, these are all institutions that live in that are of our popular culture, and so that I think that's something to keep in mind as well.
I was just going to say that because of this theme of these 4 horsemen of economic resilience that I call them, I think it presents much more risks extrinsic to the U.S. than intrinsic, because I think that the U.S. economy, honestly, is too strong for the Fed to mount an aggressive cutting campaign, and that means that the US dollar will stay too strong for the rest of the world's economies. And so you're seeing this situation in Egypt developing in real time, where the black market exchange rate is basically doubled, right? It's gone from 35 to 1 to 70 to 1. I was in Egypt in April, hearing these horrible anecdotes, like our guide. She sold her used car, looking to basically upgrade her car, and then like within a couple of weeks, the price of her used car had gone up 50%. She had to beg the buyer to sell it back to her at up 25%. Well, that was when the Egyptian pound was 35 to 1. Now it's 70 to 1. So I think you're going to see more of this happen outside of the U.S. And honestly, the big boogeyman that would be a deflationary counterpoint to the structural inflation is that if China were to devalue, right? Chinese yuan has been steadily cheapening, but because it's a closed capital account and controlled currency, they've been kind of intervening. But I think China honestly needs to devalue because they have major problems flogging that dead horse economy.
Thank you all. We've got about 1 minute until we get some data here, but does anybody have anything to add? Maybe last bear on what's been said so far?
I guess I would just add that I recognize all the rationale for what folks have been saying around reacceleration of inflation, or sort of the more longer term trends. But I do think that from just a practical perspective, the progress on inflation has been faster than expected. I think the Fed has been very happy with that progress. I think that their bias is towards being supportive rather than overly punitive, given a backdrop of sort of rapidly falling inflation by most measures, even if there's arguments for why those might increase in the future. And I think that those arguments are front and center for the Fed, rather than sort of what some of us might consider to be a longer term policy mistake.
Thank you, last bear. So like I said, we should be getting some answers to some of our topics here in just a minute. So while we wait here, I'm just going to give panelists a moment to digest a little bit of the main points that come. And then I am going to want to pivot a little bit towards some discussion on the RRP and the Treasury some more. But for now, let's just give our panelists a minute to digest, and feel free to chime in with any comments as you glance over.
At an initial glance, I don't see much of a surprise here. I don't think anyone was expecting a surprise. I think everyone's looking forward to the presser to sort of read the tea leaves on, how Powell addresses questions with respect to when rate cuts come, questions about QT, et cetera. But nothing in here is surprising, and none of it was supposed to be. So no harm, no foul, I think.
Yeah, sitting right on that expected pause. Anything that you're seeing here at a glance, Joseph?
Yeah, I agree with the last bear. It doesn't seem to be, I don't expect it to be eventful. It seems like they removed that sentence about the US banking system being sound and resilient, moving away from the regional bank panic last year, although we do have that small bank in New York today that's causing some excitement.
Obviously, stocks are down, bonds or yields are up. So obviously, I guess some people were hoping for something more dovish than what came out, but I don't see it as being a big surprise. And obviously, these moves often go the other way in short order, so we'll see.
So to kind of get things rolling, I actually do want to touch on that topic of banks. So I'm actually going to pick on last bear to start here, and then I do want to kick around the panel, and then again, we can also touch on anything else that you notice in the FOMC release as we go along here. But last bear, I was wondering if you could briefly touch on the growing divergence between cash balances at large banks versus small banks, and some of the consequences that continued quantitative tightening could have for those banks whose cash flow is shrinking.
Yes, that's actually a great point. I think that so first, on an aggregate basis, what we've seen is that cash levels or sort of liquidity within the banking sector has increased pretty meaningfully since I would say summer of this past year, and that goes back to the dynamics with the reverse repo facility and bill issuance, and to a lesser effect the BTFP facility, which has grown in recent months. But so generally speaking, the banks have more cash on hand than they did 6 months ago. But if you look at which banks have that cash, it's almost entirely in larger banks, which are sort of the top 25, which make up a majority of the total banking assets. But obviously, the banking system is huge and makes up a small number of the total banks if you were to count them. So from the small banks, we actually see cash balances sort of shrinking or staying more constant. And so a lot of that liquidity benefit seems to be going to the large money center type banks. And where that could be problematic is obviously, there's been a lot of concern around regional bank stress over the past year. Some of that has been founded, some of it maybe not as founded. But obviously there's higher commercial real estate exposures. There's less regulatory constraints on those banks, so arguably they could be, they're not subject to as strict regulation. And obviously, we saw today, New York Community Bank took a dive on credit losses, in addition to some other factors there, but a huge increase in provision around some of their holdings there. And so I think that is, and it will be in the Fed's mind when they're thinking about the pace of QT going forward, what happens when the reverse repo facility gets drained, and how far they want to push the banking sector, recognizing that there are some risks, particularly probably on the smaller bank side. And obviously they made the decision to end the BTFP facility in March, which doesn't mean that those loans need to be repaid in March, but nevertheless, it is sort of an overhang that's going to have to come out, and a lot of that borrowing does happen from small banks. So I think there's different arguments. I think Joe will have a different perspective on it, but there's definitely room for the Fed to continue to tighten and sort of turn the screws till something breaks, and who knows exactly when that will be. But it remains a question as to how far the Fed wants to sort of push it, and I think it is a consideration that they'll keep in mind, particularly when it comes to the pace of QT going forward, and particularly if we see the RRP reaching down close to zero in the coming quarters.
Thank you, Les Bear. So let's get into that a little bit. We've got, a little under half an hour before JPAL talks. I do want to cover that topic of the RRP in relation to QT. So there are still concerns abound of the RRP reaching zero by, I think they were saying June of 24, and carrying with it a risk of liquidity issues. Now, one course of action that's suggested is that the Fed can match the pace of QT to the RRP to kind of slow the balance sheet runoff, but a rising bill share could undo this. So, Joseph, you actually wrote about this in your recent article, Passing the Buck. Could you walk us through this concept a little bit and how the Fed could more safely manage the QT and RRP situation?
So one of the things that I'm looking for in the presser is how the Fed is going to handle the tapering of QT. So since the last meeting, we've been hearing more, beginning with the minutes that were released, that the Fed is thinking about tapering QT. And this is part of a normal process of ending QT. So if we think back to what happened in 2019, the Fed tapered QT for a few months and then finally ended it. So a taper could be potentially a signal towards the end of QT. And again, we are also embarking upon a rate cut cycle, seemingly as well. So there's a few views on the Fed as to how to go about tapering QT. We have one person who's saying that we should start tapering QT when the RRP gets to zero, and that's been getting a lot of attention. But we have other people who are looking at the level of reserves in the banking system as a signal to when to taper QT. So I think it's an open discussion right now. The thing is that this is something that is in part going to be dependent upon what the U.S. Treasury is doing with its issuance schedule. because if the US Treasury were to issue more Treasury bills, that drains the RRP quickly, and that also puts upward pressure on money market rates, which many Fed officials monitor as a sign as to whether or not reserves are getting scarce and you should start to taper QT. So we haven't had the pressure yet, but based on what I'm seeing of the Treasury issuance, it still seems like QT is going to taper, from my perspective, is probably not going to start until maybe Q4 of this year. But maybe we get new information from the pressure that could change that.
Thank you, Joseph. Any comments to what Joseph said? So I do want to continue down this general line of thought, but I want to kind of just take a touch back here at the bonds discussion as well. So JP Morgan has said that the US corporate bond spreads are at risk of widening next month, and that February is often a difficult month for the debt. I'm going to start with Jem here, but I do want to kick this around the panel as well. What risks does a widening of bond spreads carry, and what sort of market reaction would you expect to see should February prove to be as problematic as expected?
Yeah, I mean, we've kind of talked about this, but outside of the core center in volatility, which is, I would say, equity markets and the indexes specifically that everybody pays attention to, volatility has not just been increasing kind of in the last 4 months, but really the last 2 years. And vol supply outside of this core center has been very weak. There's just been so much vol supply coming into the center that it's been able to kind of hold everything at bay. A unpinning of that center, my opinion, will ultimately come from the bond market. And maybe that is via FX and other places. But once the bond market, which is already kind of weak in terms of vol supply, really starts to do a bit more kind of wild gyrations, I think it can really, especially given what I view as a slightly weakening vol supply issue at the core center of the indexes, could really serve to unpin the whole thing. I'm not saying that in kind of doom gloom, but it's just I've kind of expressed this as a sumo market. Some people use the analogy of a like tectonic plates. Just because implied volatility is low, just because those sumos who are like pushing up against each other aren't moving for a while, or those tectonic plates which have massive pressure upon each other aren't moving, doesn't mean there's not structural pressure and potential energy building. You can see that by all the components and the pressures underneath that are kind of pushing up against each other in a lot of ways. But the potential energy in this market, this sumo market, as I like to call it, are significant and building. And all it takes is a little shift of a toe or a little shift of that plate to get an earthquake, or 500-pound bodies flying across the mat. So I think it's just important to note that even though things seem very, very placid and markets seem very stable, if you look underneath the surface at the components and what's happening to vol supply and how things are moving and rotating, there's significant risk. And if you can see that anywhere, it's in this bond market. So very relevant to what we're talking about here. A widening of these spreads would be a big warning sign. And again, I think that core, that what I've called kind of the Dutch boy with his thumb in the dike, which is like structured product supply, the vol supply in the indexes, is starting to thin a bit into this rally. As we see market up, vol up, dealers are having their vol taken away from them into that rally. And I would be very careful as you start to see that again and again to understand that this has been a very critical kind of holding back of what's otherwise potential energy, and something to watch very closely.
If I could offer a viewpoint on the credit side of the spectrum.
Please.
So as a former capital structure ARB, right, I kind of learned this the hard way, which is, as when you're arbitraging various parts of the capital stack, you have to identify specific risks and try to immunize them. And so I often had to have specific interest rate hedges on against my book. I had to have specific credit spreads on against my book. And when you go to what I said earlier about when you look at the risky yield being comprised of the risk-free rate and the credit spread, what I've often noticed is that in periods of tightening rates, where the risk-free yield moves up quite a bit, you see a knee-jerk tightening of credit spreads, which seems kind of counterintuitive, but I would explain it this way. If you are a yield buyer, an outright yield buyer, you're generally underwriting to overall risky yield. And so if you were underwriting to say like an 8% yield at a 3% risk-free rate, if all of a sudden the risk-free rate goes to 5%, well, overnight, you're still underwriting to that 8% yield. So that inherent credit spread component gets compressed. It only takes a bit of time before you realize that, wait a second, that 8% credit, that 8% yield that I was underwriting with 3% risk-free rates, it probably should be underwritten at 10% now. That process takes time. And if you look at where high yield spreads are, right now they are at near all-time tights, which is pretty remarkable. But I think that what I just explained might be part of it. And you will see inevitable widening.
So another thing I really want to touch on here before we get into this presser, I want to keep on that topic of the balance sheets again here. So last Bear, in your recent publication, The Other Lever, you discussed the concepts of inflation versus the balance sheet policy. And you mentioned that rapid inflation occurred during a historic expansion in money supply, and that rapid disinflation occurred during a historic contraction in money supply, to which you said was driven by balance sheet policy, not inflation. And that balance sheet policy is arguably more important than interest rate policy over the past several years. Could you kind of walk us through that a little bit, Last Bear?
Yeah, I guess the argument there is basically that the reason for the massive expansion in money supply in 2020 and 2021 wasn't a result primarily of bank lending or sort of private credit creation. It was a result of balance sheet policy, i.e. quantitative easing, which creates bank deposits as a result of it. And we've seen that sort of, we've seen the total money supply sort of mirror the overall Fed's balance sheet, as that's been sort of the primary driver, both of the significant increase in money supply and then also the decrease that we've seen once sort of quantitative tightening started in 2022. And so I guess my point around that is that I think a lot of our historical framework centers more around sort of credit creation and the cost of credit and sort of interest rate focus, which obviously has historically been the primary tool to influence money supply and sort of the growth in credit overall. And I think that increasingly that's not really the best framework to understand how monetary dynamics work today. And the past several years have shown that balance sheet policy has been a more significant driver. That being said, money supply has seems to have inverted upwards a little bit. Some amount of that might be due to some of these kind of esoteric issues with the reverse repo and how funds flow in between that and the banking sector and whatnot. But overall, I guess my point was that the Fed has in some ways stepped into markets in a more direct way than they ever have before, both with their ability basically to increase and decrease the total amount of bank deposits and base money that's out there. And despite the fact that that has been the primary driver, it doesn't get nearly as much attention as the rate dynamics, I think primarily because that has historically been the framework that we've used. So I think just sort of focusing people away from solely looking at rates and thinking about how quantitative tightening and easing might have influenced inflation and disinflation over the past couple of years, I think is the key point.
Thank you, Last Spare. Does anybody have any comments on that before I pick on Jem one more time and then get to closing remarks before the presser? All right, so Jem, we can't wrap up any of these macro panels without some more volatility insights. So I'm curious here. Earlier this month on the Schwab network, you mentioned indications that vol had bottomed. Now, as we wrap up this first month of 24, what are you seeing in the options flows, and what's your outlook on vol as we move forward? Has vol indeed bottomed out, Jem?
Yeah, the trend is higher, and that's really I'm talking about 60-day vol on out has bottomed and will continue to work its way higher, I believe. That said, very important kind of inside baseball here for people tuning in. If you look at the S&P vol structure, the term structure, it's been about a bit of a U. We haven't seen this in quite some time. You see this during big event vol sometimes. But what do I mean by a U? I mean the very short dated 1, 2, 3, 4, 5 day vol is quite high because of this Fed meeting, the unemployment number, et cetera. But as you get out to Feb OPEX and 2, 3, 4 weeks out, it really bottoms, and then you see a March OPEX, which is a quarterly OPEX, and the next Fed meeting is dramatically higher. What that does is when you have that type of vol structures, it creates what we call VOMA and Veda exposure for dealers. What is that? That means that the dealers are decaying longer volatility over time, and as the vol compresses on the curve, that means the whole dealer network is being delivered a bunch of implied volatility in the next 24 to 48 hours. That's broadly supportive and compressing of implied volatility over the next week. That doesn't necessarily mean we're going up. Yes, there are structurally supportive flows that come off of that. But in the face of what we've seen from a macro perspective, quite negative kind of flows and news. So that won't tell you up or down. I'm sure that's what everybody will want to know. What it'll tell you is less likely to be a tail event and a vol spike in the short term, as people are decaying longer and longer. When I say people, dealers are decaying longer and longer implied volatility. So, we got this move back to 4,900 here, where there's a lot of open interest and a lot of positioning in the futures. And you're likely to see some, after this event, vol compression and some placidity for a few days. Now, that doesn't mean we can't continue to drip lower. It doesn't mean, we can't reverse and rally back. But what it does mean is a lot of this vol bid that we've seen recently is likely to come out of the market for the next couple of weeks. It could be a situation where vol gets compressed 30 days and on forward, but you start to see a continued relatively outperformance of 60-day and 90 days still, which is what we've been seeing, and then into a potential coming rally again in the next weeks that follow, or even a sideways to downstairs, down step into Feb 14th that we could see, again, a relight to longer term vol. So I would be very bearish of implied volatility 30 days on forward at this point, despite being broadly structurally bullish of longer term. So calendars in this environment are a good place to be. A longer, again, upside calls, longer dated, even some puts on a lower skew, longer dated, and funding that with short term and maybe even a little short vol for the relative short period of the next week or so.
Thank you, Jem. So what I want to do here before we get into the presser itself is I just want to kick it around the panel one last time to get any closing remarks or anything you feel we didn't touch on enough during the panel. And of course, plug anything you got coming out that you need the listeners today to know about. Let's start off here with Michael. Anything else you wanted to add here at the tail end?
I would just say that to my earlier comment about how, because of, U.S.-centric resilience causing this dynamic where the Fed is likely to stay tighter and longer than the rest of the world, look no further than oil. To me, oil is the global canary in the coal mine. It is a global commodity. And despite, 4 to 5 OPEC plus cuts, despite all of this geopolitical escalation, you're seeing it just unable to rally. And so just watch oil. And yeah, you can just find me at Urban Cowboy, and my Substack is urbancowboy.com. Thanks.
Thank you, Michael, and thanks again for coming as always, man. It's always great to have you here. Last Bear, anything you wanted to add here before we send people into the presser?
I guess I would, well, first you can follow me here. You can also subscribe to my Substack, which you can find on my Twitter page, thelastbearstanding.com. I guess I would just add the one area, and I mentioned at the outset, and I just want to clarify my comment, but I mentioned the labor market. And I think that's been a source of surprising strength for a long time. And that view has, it's supported the market, it's supported the economy. But I do think that that's the one, if I was going to pick one area of the economic strength that is potentially flashing more warning signs, I would pick the labor market. And so I think my general perspective is sort of bullish on continued growth, sort of generally bullish on equities specifically, but the one area that I would continue to sort of watch for deterioration that would make me change my mind would be in the labor market. So there's a huge number of different ways that we can look at that. But pretty much all of those measures show easing from a very tight labor market, easing in wage pressures, which obviously is not supportive of an increase in inflation. But if those start to go from easing to cool to negative, that's where I think that the soft landing story goes awry. So that's what I'm looking sort of on more of a longer term perspective, and I think that does sort of hang in the Fed's mind more than maybe some of us are giving credit for. So thanks again. Thanks for having me as always.
And thanks as always for coming, Last Bear. Always crucial to have you here for these. Thank you. Jem, anything you want to add here?
Yeah, I guess one more add-on to that vol picture that I didn't mention is I think the very important thing to note that was kind of somewhat historic that we're seeing is that in the tech, Mag 7 in particular, names, lot of long calls being bought by customers because it was very profitable. That flattened call skew. So really, has taken call skew in those names to historically inverted levels. And that actually is an important sign, because when you start to see that call squeeze that you see and that dealers are short those calls and net long stock, and you get something to not necessarily make those names crash, but again, negative earnings like we've seen, a slowing of the momentum, what you see is those calls now start to decrease in value and decay, which leads to the selling in those specific stocks of stock by dealers. There's a lot of potential energy, in other words, in those tech names for continued selling by dealers if we continue to see some placidity. And given the negative news and given the vol supply I just talked about in terms of the U structure in the short term for broad indexes, what that will likely mean is a dispersion where other names outside of the Mag 7 perform and relative. It might be into a declining stair-step market or whatnot, but I think it's very important to note that strong Mag 7 will lead to likely what we're seeing today, which is kind of upside down, some what looks like breadth. But don't be confused by that breadth being healthy. It's really a function of a vol supply at the index level short term, paired with the opposite in the indexes and a decaying of vol on the call side in the Mag 7 and the big tech stocks, and what that means for dealers. So just be mindful of that. I think you could really see this rotation continue for a bit. And maybe the beginning of a much bigger rotation. So be very careful if you're in that Mag 7 and you're looking at tech after those earnings, not just because they're bad earnings, but because of what it means for volatility, structure, and flows coming off of that. If you want to follow us, kaivolatility.com/news. You can get kind of our most recent media and updates. And then obviously on Twitter here, Jem_croissant. Well, always a pleasure being on here with all these guys. Thanks for being on.
Always a pleasure to have you, Jem. Thanks so much. Joseph, anything you want to send these folks into the presser with?
Well, first of all, thanks so much for having me. I always learn a lot when I'm on this panel. One of the things I notice about markets is that relationships always change. We had this big regime shift in 2008. We have a big regime shift after 2020. And so I think it's really important to note this because, for example, reading about Michael's four horsemen, fiscal spending, demographics, that's really helpful in understanding how the world would change in a fundamental way. Listening to Jim's views on volatility, that becomes increasingly important in shaping price action, right? And of course, the last bear talks a lot about how changes in the Fed's balance sheet, that all impacts things. So I think it's really important. All you guys should take a look at the work presented by these panelists, because I think we're a lot more dynamic than what you learn about in textbooks. And so it's important to have that flexibility going forward. Bob's not here, but I always learn a lot about Bob about fundamental data, labor employment, and so forth. Definitely follow him on Twitter. And if you're interested in my take on how this FOMC turned out, I'm going to be posting my FOMC debrief on my YouTube channel, Joseph Wang, afterwards.
Absolutely check that out, folks. And just like Joseph said, everything these folks put out is just invaluable in terms of learning. And it's definitely better than, reading by yourself. So I would highly recommend checking them out.